So it's just this awkward middle or messy middle, I think, that you're in. But I do think once we get towards the election, past the election, into the end of the year, that we have the opportunity for growth to once again re-accelerate. If you think about it, individuals, consumers, they're still in very healthy positions. Of course, they don't have the firepower that they had from the stimulus that they received post-pandemic. That has been drained down, but they're still, they still have room from a credit perspective. When you look at credit as a percent of disposable income, it's back to pre-pandemic levels, but those were low levels, nowhere near financial crisis levels. So I think the consumer is still in good, resilient shape. They do have job opportunities, even if they have to reskill.
Bueno, pues una vez más está aquí con nosotros Lindsey Bell, que es habitual colaboradora de la CNBC, estratega de mercados. Vamos a hablar de economía, de tipos de interés, de la situación de los mercados en Estados Unidos, y seguro que tiene muchas cosas que decir, que la otra vez también comentó mucho. So, thank you very much again, Lindsey. It's a pleasure to have you on my channel again. For those who don't know you, you are a market strategist and a regular contributor to CNBC. So, a really pleasure again, and let's talk about the markets.
Sure, let's do it.
Okay, so first of all, you comment in the last conversation we had that 2024 was not going to be an economic recession, and those forecasts are coming true. So, do you see the U.S. economy being strong between now and the end of the year, or your vision has changed?
No, I'm still optimistic about the path for the economic growth in the US. I do think it's possible that we're hitting a little bit of a lull or a softening in some of the economic data, especially with regards to the consumer. We've seen retail sales coming a little bit weaker than expected, consumer spending, jobless claims are starting to tick up a little bit. And some of the jobs data, the monthly jobs data, has been a little bit wonky. So I do think there's a little bit of a concern about the consumer here. And I think a lot of that too is probably predicated on where inflation goes from here.
Mm-hmm. Yeah, that's true. In fact, I want to ask you about this recent data that we known as retail sales. Do you think we are going to a deceleration, or maybe a slowdown of the economy right now, or not? Or are pretty the numbers just pretty good, pretty solid, or what's your
I
opinion?
So I think we are maybe hitting a little bit of a lull here. I think the consumer is recalibrating. I think even corporations are recalibrating what they need from a labor perspective as we all think about what AI being coming into the economy and across industries means. And how it's going to impact the workforce. And I do think that it's going to be a good thing on the other side. I just think it's a little bit of a recalibration. It reminds me of what we saw in the 90s, when the internet and automation was becoming much more prevalent. So it's just this awkward middle or messy middle, I think, that you're in. But I do think once we get towards the election, past the election, into the end of the year, that we have the opportunity for growth to once again re-accelerate. If you think about it, individuals, consumers, they're still in very healthy positions. Of course, they don't have the firepower that they had from the stimulus that they received post-pandemic. That has been drained down, but they're still, they still have room from a credit perspective. When you look at credit as a percent of disposable income, it's back to pre-pandemic levels, but those were low levels, nowhere near financial crisis levels. So I think the consumer is still in good, resilient shape. They do have job opportunities, even if they have to reskill. And then I think corporations are also still very healthy. They have a lot of firepower in terms of cash. The debt wall that was coming in 2025 has been pushed out as credit spreads have remained tight, and these companies have been able to refinance some of their debt and push out the maturity dates. So I still am a believer in the economy right here.
Mm-hmm. How do you read the numbers related with labor market as for example, we saw the last numbers that full-time jobs are going down and temporary jobs are speaking up. So that rotation in labor market are maybe change the current scenario, or what's your point?
Yeah, I think it's just that really speaks to the changing dynamics of the labor market. And I think it's a little bit confusing. And I think all of us are trying to dig into the data points because that type of data, along with another data point that I've been looking at, is just the labor force in general, which includes those employed and unemployed, has peaked. And so it's remained very steady at high levels. And those types of data points can be a sign of economic weakness to come. And so it is definitely something you don't want to just brush off, and we got to keep our eye on. But my position is you're also seeing part-time work, multiple job holders, small business growth coming down the pike. And I think it's really just a change in the way that we work, which can benefit the economy over a longer term basis.
So, talking about inflation that you mentioned before, it seems that in May and June there is a slowdown in the rise. Is the inflation problem solved, in your opinion, or could there be scares in the walk, or what's your perspective in that sense?
I don't think we've solved inflation. I'm glad that we're starting to see progress once again. And I think from the market's perspective, I think, look, we're still making progress, but it's really slow progress. It's not the same rate that we saw at the end of 2023, right? And even Fed Chair Jay Powell has said that it's going to be harder to see that progress in the second half of this year because of the comparisons last year. So it's going to be harder to see progress continue at the clip that we saw, again, like I said, at the end of 2023. So I do think that there is more work to be done. Shelter has been a lot stickier than many people and pundits and economists had predicted. Auto insurance, it's again, we're seeing improvements, but not significant improvements. And I think the Fed has talked about how they're worried about wage growth. They'd like to see wage growth come closer to 3% to feel more comfortable about cutting rates. So I think more progress needs to be made. Right now, the market has become comfortable with higher for longer on interest rates. And as long as some progress is being made on inflation, like we saw in the last month, the market's going to be okay with it, because their biggest concern is that the rumors that we heard earlier this year, when the economy was doing better than expected, is that there could be a hike on the table. As long as the hike's off the table and we're making small progress, the market will be okay. The question, though, for me is what is the timing of all of this? Because you're starting to see weakness in the consumer, a little bit of softness that we already talked about. And I think that is because inflation has remained hotter than expected. Food prices are up significantly in the past 4 years. Consumers feel that. You can't just strip that out. You can't strip that in gasoline prices, which are also up significantly since 2019, out of the numbers. And so it's impacting where they're spending, how they're spending, and it can impact the economy. So the faster inflation can come down, the better. But I think it's still TBD. No one exactly knows where we're going from here.
Yeah, and one point it's supercore service CPI are in 5% right now, and Federal Reserve, what are going to do with that inflation levels, right?
Right. No, and the other thing that I would point out too, to make the case that the Fed doesn't really know what's going to happen with inflation going forward, is they increased their inflation outlook in their most recent dot plot to 2.8% from 2.6%. Well, 2.8% is where the core PCE is. The most recent reading of the core PCE is the April reading. And so they're not expecting any progress in inflation over the remainder of the year, right? That is what that suggests, which I think also just suggests that they don't really know where it is going. It's been stickier than they had expected, so they had to adjust. But we will see. Services inflation, everybody kind of got excited about that, the super core excluding shelter, because we did see the first month in, I think it was 2 years, with a decline. So that was really great to see. But can it continue? It's still high on an
Yeah,
overall
exactly.
basis, and the consumer feels that.
Yeah,
So we
so
like the numbers from a numeric spreadsheet perspective, right? But the consumer doesn't care. They just know what they're paying at the grocery store.
absolutely, absolutely. So the next question related with that, it's in this environment, the next Fed meeting is in July. What messages do you think they will convey? How many interest rate cuts do you see this year with this scenario that we have right now?
So right now they're predicting or suggesting that they could cut rates one time this year, right? And that's down from 3 times in March. And we've got the market hovering between 2 to 3 times, depending on the day and what the economic data comes out. You see the market being very reactionary to any of the economic data that could impact rates. I think for their part in July, it's going to, Powell and co are going to keep the message very similar to what we heard this month. And it's, they're really just, they're keeping their eye on the weakness in the job market, but they're also keeping their eye on inflation. To me, inflation is still the main driver of their policy. But, they also admit that they they're just being data dependent. And so I don't expect anything consequential to come out of that meeting in July.
Mm-hmm. So, moving to the stock markets, we have all-time highs in the major index with the S&P 500, Dow Jones, and Nasdaq. What could be the top of the stock markets? Because optimism still seems to be in place. So, what's your point of view in that sense?
Yeah, I know. This is kind of the scary part is where we are right now. Sort of reminds me when we were in early April when the market started turning down because economic was good and we weren't going to get the cuts that we wanted right now. But I think it's a little bit of the opposite where economic data is softening and we might get the cuts that we want, but we're not entirely sure. We just talked a lot about that. But I think too that the underlying things that remind me of April is investor sentiment is getting stretched. It's getting much more bullish again. So we're at high levels on AAII sentiment. We also see a market that is very overbought overall. And you see when you look underneath of that, the number of companies that are making new highs or trading above their 200-day moving average, they're low levels. And so that says to me we're due for a pullback. We're ready to take a little bit of froth off the table here. So I wouldn't be surprised to see that. But that being said, it is an election year. We do have that cyclicality that benefits the market. I think from a valuation perspective, even at 21 times for the S&P 500 on a forward basis, people can point to that being extended versus history, but it's a multiple that the market has been able to withstand in higher interest rate environments when the economy was performing well. And if, my base case is that the economy is going to be resilient into the end of the year, and growth is going to be better than what we were expecting at the beginning of the year. So I think that multiple stands, and even when you take the big large cap, the Magnificent Seven out, you're looking at a market with a 17 times multiple, which isn't that far from the historical average. So I think there is room to run in some of these other sectors, and so there can be opportunity.
Yeah, and seasonality are pretty good for middle of July. So we see, in stock markets. But yeah. I want to ask you about the market breadth, because we are not seeing a healthy or health market breadth the last couple of weeks. So can this be a negative? You mentioned a little bit of that before, but what's your opinion about current market breadth in stock markets?
Yeah, no, I definitely think breadth has been weaker than what we'd like to see. We like to see a market that's being supported by a broad array of stocks, right? And not just being led by concentration. But the fact of the matter is, in many bull markets, you do see this concentration occur. But I think there's going to be an opportunity for a broadening out. I think it's just a signal that we might be due for some near-term weakness, which is, again, okay, it's healthy. We get usually 3 to 4 pullbacks of 5% or more in any given year. We get a 10% correction usually at least once a year. So I don't think it's anything to fear. Again, it's one of those things you want to watch. It's a signal. It's not an end-all be-all, but it's definitely just another data point, another piece of the puzzle that we're putting together when we're trying to think about where the market goes from here.
So what sectors are interesting now until the end of the year in your opinion?
So to align with a lot of what I talked about, I kind of go with a little bit of a barbell effect where I like some of the cyclical sectors like industrials and materials on one side. And then on the defensive side, I like healthcare, but I also kind of group technology in that sector. Or in the defensive side of the barbell. And so for industrials and materials, these are two sectors that came into the year doing well. but have seen more weakness recently, have underperformed the market. They didn't have a great earnings season in the first quarter, and we saw some of the numbers cut into the end of the year. So investors have become a little more cautious on this sector. But when I look at it from a valuation perspective, when I believe, you're a believer in the resilience or resurgence of the economy into the end of the year, these are two sectors that can do well. Also, you can't forget the amount of spending from an infrastructure and defense perspective, especially when we think about the geopolitical concerns in the whole world. So I think that there is opportunity within those sectors. I'm not saying today is necessarily the day to buy, but we have more recent economic data, industrial production, the New York Empire Manufacturing Index coming in better than expected, with expectations from those data points showing more optimism. So I think if manufacturing stabilizes to improves a little bit, these two sectors can take off. Healthcare, defensive, especially if we are going to get that lull. That's the one sector that has resilient earnings and resilient performance in an uncertain environment. But also they've got the innovation, and it's not just a couple of companies. There are a lot. The biotech industry within the healthcare sector has become much more quality than it has been in the past from a cash and debt perspective. So I just think there's opportunity. It's been an unloved sector, and I think there's opportunity in the middle of the year for that. And then technology, I think I talked a lot about it already, but valuations within this sector, the opportunity for margin expansion, it's already one of the highest margin earning businesses within the S&P 500, but the expectation is those margins are going to expand. And growth, earnings growth is not crazy. A lot of people say, hey, like the AI craze is driving expectations for growth, and it's not. The Q1 earnings growth was 25%. We're projecting 19% earnings growth for the full year, which is well above the S&P 500 at 9.5%, 10% growth, but it's not crazy, especially when you think about the opportunity that AI could bring in the margin expansion and all the things that are going on. And the sector has become also greater known for its quality, its cash position, its low debt position. Heck, some of these companies are issuing dividends, right? Alphabet, Meta, Salesforce. So I think there's wide range of opportunity there.
And just one more question that I thinking about when you are talking about the current situation in stock markets, and are not related with stock markets. It's just about other markets, as gold, for instance, or maybe a long duration in fixed income. But if we won't expect a lot of rate cuts, maybe we don't have a great exposure to long duration. But what's your opinion about fixed income, long duration, or duration in fixed income, and some assets as gold, silver, or commodities?
Yeah, no, I think that fixed income should always be part of your portfolio. I think it's harder to be in the long end in this type of environment when the next move is likely lower for interest rates. But still the lower end of the yield curve, the rates look really good there. So I think that there still is opportunity on the short end. I do think that corporate in the medium range, maybe 3 to 5 years, can offer opportunity. Even in the high yields, you look at the spreads and they're so tight that it suggests that the risk isn't significant. So I think you look for the higher quality names in that space, but I think there's definitely opportunity in fixed income.
So great, Lindsey Bell. Thank you very much for come back to my channel, and this is your house whenever you want.
Well, thank you for having me. It's always great speaking with you.
Thank you so much.